And I'm passing the mic over to Lisa.
Thank you, Odie, and thanks everybody for joining today. I recognize that you and your communities and a lot of your constituents have been really hit hard by these recent storms and hurricanes, so I'm glad that you're able to make the time to join us. If you haven't, please introduce yourself in the chat. I really encourage you to chat in or raise your hand or come off mute and ask questions throughout this because we're talking about a subject that is not exciting for everybody, but I get very excited to talk about today. And it's about finance. So I'm always thrilled when this many people show up to talk about finance, particularly when they're not in the finance role at their organization. And so, the title of today is Navigating Finance. And I really believe finance is a critical part in an organization's story. And you can't thrive without telling your story. So how do we connect those two things? When you understand your financials or your finances, you can speak holistically about your impact and what it costs to deliver your work. So we're going to start with the fundamentals today. We're not going to be going deep into the storytelling aspect, but this is going to prepare you for those conversations or for future webinars that we might do next year. And so, we're going to introduce the fundamentals of what the nonprofit business model is. So let's all use the same language when we talk about finances. We are going to talk about strategy and compliance and how those are related for mission success. And we're going to look at your own financial information and do a little interpretation around what those statements tell us. All right, so just to kick off here, I like to do a poll to get a sense of people's comfort levels when we talk about finance. So if you can just quickly answer this, what's your level of financial comfort? Sometimes when I do this, I know the real question that people want to see is like, I don't want to be here. Finance makes my eyes glaze over, but I don't like to put that as an option. All right, so we have a nice variety here. Terrific. I'll give you just another second. So, kind of in the middle here, somewhat considerable, a few experts, that's terrific. So hopefully for those experts in the room, you still come out with something here that is valuable and that you can apply. All right. So we are talking about finance today, but I would be really remiss not to talk about how this relates to your bigger organization. So whenever I talk about finance, I like to first show, how do organizations really support their mission? And finance is one piece of that puzzle. All organizations have a lot of strengths that you're operating from, and these are financial and non-financial, and they're equally important, I would argue equally, to having mission success. And so you have your programs and your services. So what you do, how you do it. You have your people, your culture. This is the heart of the organization. Most nonprofits, this is really what makes you thrive, is your people. You have your collaboration. I think of this as your social capital, how you're centered in your community, the relationships that you have with stakeholders and with partners. You have your finance and the money, and this is both the types and the amounts of money that you have and how you manage it. And then you have your infrastructure and systems, which really, that's your support. It helps your operations. It's really a key part in organizations, particularly as they grow. And together, all of these create mission success. And this is what allows an organization to be strong and resilient. And I have in the center here that compass or the North Star. That's kind of where you're always shooting for, is that North Star. And traditionally, when I talk to organizations and when I do consulting with organizations, I ask them, what are you most comfortable talking about? And easily it's going to be your mission, because that's why you're there. Your people, who you serve, your impact, those are the things that you become really well versed in. This is what we do. This is how we do it. But there's really an importance in being able to say, this is how much it costs. And these are the resources that we need in order to do that work too. And so that's really what we're going to focus on. And I recognize finance is really hard to talk about. This is Samson, who's there. He's my 13-year-old dog who's sitting behind me, and he is a very good boy, and he likes to always make his presence known. So either he's whining behind me or he's in my presentations for that reason. But why is finance hard to talk about? For a lot of reasons. It's filled with jargon, for one. All right. So we have a lot of different words that mean the same thing. We talk about your balance sheet and your statement of position. It's duplicative, it's redundant, and there's jargon. The bottom line is red. And there's not just simple language that we use to tell the same story. It's also personal. It's really natural to feel apprehensive when we talk about finance because there are elements of taboo based on your personal and your cultural experiences. And it is very hard to shift that mindset. And that's okay. For small organizations particularly, you might have an executive director that comes and now is in charge of a whole lot of money that they're receiving. And in their personal life, that's never been an experience of theirs. And so there is an element of shame sometimes that comes with that, and of anxiety that comes with that. And those are perfectly normal experiences. I say we here, but really because I think of myself also in that nonprofit space. We aren't nonprofit finance professionals. You probably work in your organization because you care about your mission. And yes, there might be some finance professionals on this call, and that's great. But my guess is you still are connected to that organization because of its mission to some degree. There's also a dissonance between what funders are asking you and how you think about your financial strategy. What you need to put into a budget or a report is often not the way that you would think holistically about what your needs are. And so there's just this lack of alignment that exists. And then finally, it can be carefully curated or not. There are many ways there are many ways to manipulate what that story is for your financials. And if you don't manipulate that or provide context, an external audience is going to have their own interpretation of it. And so it makes it very challenging to make sure that you are providing that story in a way that is telling exactly the events that have happened and why they've happened. So all this to say, there are no dumb questions when it comes to finance. If you're not comfortable asking a question here, feel free to email me afterwards. And I would always be happy to answer anything that comes up. So I'm going to say, I think it's a fair assumption that most folks here know that the nonprofit business model operates different than the for-profit business model. And that's a really fundamental piece that they're different. But I also want to acknowledge it. When I looked at the list of who was attending today, there's a range of organizations here, and there's also a range of experiences in your financial comfort. You're coming from different budget sizes, from different expenses. But one thing that is in common across all the groups that are here is that you work with a beneficiary. And that could be a person, it could be a community, it could be an animal. And they are not paying the full cost of your services. Maybe they pay something, but it's subsidized. And so it's not that one-to-one transaction, like if I went to Starbucks or I went to a bookstore where there's a customer and somebody on the other side making that sale. You have this third party on the left, the funders, the donors, your earned revenue, and they're necessary to drive your operations. But from a relationship perspective, you're also managing a lot of expectations by doing that. That group on the left, they want information about your beneficiary, even though they're not directly connected. And so you're managing two sets of relationships at the same time. So I often would argue that the nonprofit business model is much more challenging than the for-profit business model in that way, because you need a whole lot of skill sets to manage all of those relationships. And so grants and donors, they're necessary, but there's also strings that come attached with those funding sources that you receive. You get restrictions, and that is by time or purpose. We're going to talk a little bit more about restrictions in a few minutes, but there's strings attached. It's not just your money to use free and clear. It's money that has very clear stipulations on what and how to manage it. the funding probably also doesn't cover the full cost of your programs. And so if you receive government funding, particularly federal government, that won't cover your food or your capital expenditures or stipends. There's a whole list of things that you can't use that are unallowable. Or if you work in the arts and culture space and some of that state funding is no longer available, you'll need to start learning how to braid funding from other sources to cover your full operational costs. And so that's another challenge of really getting that full cost covered. And because you're managing different people and relationships and funding sources and grants and reporting, you're not just delivering on your mission. You need this whole other skill set and capacity and time to manage your payers. I often hear in the nonprofit finance space this need for diversified revenue. That's kind of a buzzword. And I often hear boards saying we should, you need diversification. And having different sources of revenue is important. But lots of diversified revenue creates new challenges for an organization because different revenue streams equal different business skills that you need. And whenever I talk about this, there's a book that I used to read as a child that my kids both love. It's the Caps for Sale. I don't know if anyone's familiar with it. It's about a peddler and he walks down and he has all his different colored hats on and the monkeys steal his hats. But that's kind of what I think about when I think about diversified business skills, is that you are this peddler with all these different hats as a nonprofit organization that you need to manage. And for one, you have the fee for service. Okay. So the cap here, whoever is paying for your service probably isn't paying the full cost. But your cap here is that you're probably going to have some kind of contract manager. You're going to have admin and finance and reporting to do, and you still have to deliver your services. And then you have your subsidy revenues. And this is really a core component of your business model. These are your grants, your contributions from individuals maybe, and then earned income. And all of these take their own capacity to deliver. So you need to have a development team, or if you don't have a team, a grant writer. If you are going after individual donors, that takes a lot of relationship management, a lot of reporting to them, just really stewarding those individuals. And then earned income, maybe you have space at your office that you rent to another organization, or you have a thrift store as part of your business model. It's a whole nother set of skills to deliver that. And then something all organizations have, but you might not use this terminology, are different kinds of cost-cutting measures. Everyone does this to some degree. So maybe you have volunteers that help fill a need, or in kind, so professional services that get donated in time, but you still need to account for it. Or you have sweat equity. Sweat equity is something that I consider unfunded or underfunded expenses. So for instance, maybe your executive director works 60 hours a week, but only gets paid for 40. Or you have staff that attend events, and after that event, they actually have to stay another hour to help clean up that event, but they're not getting paid for that. Sometimes sweat equity also comes from a supply perspective of like having unfunded expenses, such as we don't have the supplies we need. We kind of make do with limited supplies. And most organizations have this, and it's become really normalized, but it doesn't make it okay. And so I'm a real believer that in order to get paid for all of your services in a fair and equitable way, you need to be able to name and claim those resources. And so being able to acknowledge what are we doing as an organization that we don't get paid for is really the first step in that. And so I want to give folks just a few minutes here to think about sweat equity within your own organization. And so like I said, this is usually associated with people, but it could also be inadequate supplies. And so to give you an example, I used to live overseas. I was in Australia, and I managed a primary healthcare program, which was a mobile medical home that worked with people who were rough sleepers in our community, and also worked with very specific cultural groups in the community. And we would take this van into rural locations and with a doctor and a social worker and a nurse. We didn't have 5G internet, and we had a router, and we were basically connecting miles away to our server that was in a brick and mortar location. And so, as you could imagine, our internet was terrible, except all of our health records were through the internet on our laptop computer. And so I would consider that subpar supplies, because my staff, when they used to have to go on the van, they couldn't do their job to the best of their ability because our supplies didn't support them. And so we didn't have the funds to go and upgrade that into whatever it would have been at the time, but that's subpar. And so it wasn't allowing us to do more work. It was allowing us to do our work in an equitable way. And so that's how I think of sweat equity from an unfunded expense perspective, not to do more, but just to do it fairly for your staff and for your team. And so, take a minute here, think through, how does your organization utilize sweat equity? What could it look or feel like if you had all your needs met? And how might it impact the sustainability of your business now and in the future? I'll invite you to come off mute or to chat in here and share some of those, because I really believe that these are shared experiences that folks have in the nonprofit space. And so actually sharing them allows it to become much more normal that we all have this. So let's start naming and claiming them. Eula, I see.
Hello, raise my actual hand. Sorry about that. Staff, particular, I work more than the hours that are scheduled for the position. Sometimes just donating some of my own office supplies from my company. I provide in-kind services. We make do with what we have. I do that a lot, bringing in volunteers. We haven't had any events yet, but we've attended one event. We didn't bring in extra volunteers, but the time to set up and break down, very much aware of all of that. And right now it's just in-kind time.
Thank you for sharing. And I think some of those, when we talk about volunteers, maybe that shows up on one of your financial statements, but the rest of it doesn't. And so an external audience, when they're looking at what does it take to run your organization, they don't see that. And so they think, when I say value, not your personal value, but the value as far as a cost of the organization is much lower than what it really is to run your services. Katie, I see you wrote the household handyman.
Sorry. Yeah, so we have, staff who have partners or other people in their family that are handy with repairs and maintenance. And we've kind of relied on that instead of hiring a professional to do some of the odds and ends that are needed around the office.
Yep. Thank you for sharing. Anybody else want to share?
Yeah, can you guys hear me? I'm Tammy Garinger with Peace River Wildlife Center.
Yes. Hi, Tammy. Thank you.
Hey. Yeah, I'm sorry. We're doing hurricane cleanup. I'm a mess. So just the utilization of volunteers, we have an army of at least 140 volunteers that allows us to provide the services that we do to the community. If we did not have that army, we certainly couldn't afford to pay what the services we're able to render. And also the in-kind donations are huge for our organization as far as just being able to take care of all the animals that come through our doors. So that is definitely something that I believe you're right. How do you put a dollar mark on that? And just we couldn't function without that volunteer impact.
Yeah. Thank you for sharing. And I think there's two pieces there as I hear that of like the in kind as far as donations, those things can be tracked. And I often see organizations not include some of those in kind donations on their financial statements, but that tells a really powerful story of the resources or the time that are coming through. But your volunteers, you're absolutely right. And so from an external audience perspective, as a funder or as someone on the giving partner who is looking at your financials online, they don't see that when they see, you know, what their donation is going towards and what it would cost if you lost that volunteer kind of force behind you. And so thinking through ways to quantify that and being able to add that as a narrative. You're not always going to be able to add that number into your financial statement, but you can add a narrative to also explain we have 3 full-time staff and the equivalent of 14 full-time volunteers if you look at our 120 volunteers that come through the door. And so thinking through those ways of how do we start adding that narrative to really give people the full picture of what it takes. Thank you for sharing.
Yeah, I know there's studies that have been done as far as what the value of a volunteer hour is. And it's, I think last time I read, it was like $32 or $33 an hour. So when we do our volunteer appreciation and things along those lines, we try to calculate those volunteer hours, do the math on that. Of course, we can't capture all of those volunteer hours because some of the volunteers don't even track the hours for us. But I mean, it is a substantial, when you look at the thousands of dollars that represents of their labor. And we did, with our new ED, we have done a better job of tracking our in-kind donations coming through the door. So that's helpful to be able to include that in our financial profile.
Absolutely. Thank you for sharing.
Sure, thank you.
Anybody else want to share something that we haven't spoken about yet?
I can jump in here. I'm Kenna with foodrecovery.org, and kind of just to add on to what Katie said, we have a running joke in our organization, Nonprofit Boyfriend, and we've been so lucky that a lot of our employees have partners that work kind of in finances and accounting. And so when we have to build like a complex spreadsheet or we're trying to automate something, they'll help us to build that out and build those formulas so then it sets and we can do it. And if I were to think about it, it's probably like thousands of dollars worth of like what we would have paid like a consultant or something that they've helped us do. And I never really thought about it like this until this call. So it's like a funny joke, but then at the end of the day, like how do we show that for future donors?
Yep, absolutely. And I'm glad that this can help bring that aha moment. And, you know, particularly from a professional service perspective, those kinds of things can be captured and put onto your financial statements. And that's exactly what in-kind would be. There's a joke, there's a nonprofit blogger called, his name is Boulay, and he writes a really interesting and thought-provoking blog every week or every month. And he always talks about the executive director chair, and he shows this picture of this really ratty, dilapidated chair that the executive director takes pride in, of like, this is this awful chair that I have to sit in that has 3 wheels broken and that's propped up. And like it becomes a laughing matter within the organization, but it's also reflective of the reality of this is how, you know, we operate and we've normalized this. And that's just, you know, that's our world. I see there's another hand raised. Oh, Eula, go ahead, please.
In terms of documenting the in-kind, would you just write a memo to file, or do you need something more official?
So yeah, that's a great question. So for in-kind, there's a few ways to document it. It would go into your income statement, and we can talk about this a little bit more as we start going into that income statement. It would be part of your budget. It would show up as revenue and expenses. It actually offsets itself, so the sum is 0. So if you had $100 of donated time and revenue, you have $100 in expenses for in-kind. The reason is it's not actually helping your surplus or your deficit. it's showing the full value or the total expenses of your organization. And so it's just an accounting transaction that you would do. And I see Kenna, I also feel like when we rely on our partners for assistance, brings the work home in a not fun way. You're right. It like makes it a little too personal sometimes of how do I keep my business life compartmentalized and my personal life separate. So thank you everybody for sharing. I always find that when you start talking about sweat equity, you know, it brings up some of the ways that nonprofits operate in that kind of normalizing it. And it also brings up some of these feelings of like, this is an unfair model that we exist in. And I think that that's okay to call that out, and that, you know, how do we change that model is by first acknowledging what it is. And so we can't make change in that system about, you know, salaries being fair, about getting more funding and getting less restrictive funding unless we start first acknowledging what the operating model looks like. So I appreciate you sharing those stories, and feel free to continue chatting in if you have other examples that haven't been shared yet. Okay, so we're going to shift now into talking about financial information and how we use that financial information to advance our mission. So getting into a little bit more technical pieces here. The first here is the sources, because I feel like this is an important kind of baseline to understand what are the types of information that's being captured according to the source of the document. And so I look at this from the past, current, and future direction. And so these are just certain examples of financial statements or financial pieces of information you might pull. Your audited statements, your 990, internal financial statements, all are going to show you past performance. Your current situation will be your budgets, again, internal statements and cash flow projections. And then as you look to the future, we're talking about multi-year projections or scenario plans or strategic plans. And this kind of financial information with additional context, so maybe that's your leadership or your mission or your strategy, is going to help tell your story and how you're positioned to navigate in the future. And so we use this information both internally and externally, and it's important to know both of them. You have to understand this information internally, so that way you can think about how an external audience is going to actually look at this data and interpret it. And so we use financial information to help understand an organization's financial health, all right? And so when I talk about financial health in the context of this presentation, I'm talking about the types and amounts of money that you have to cover your cost of operation while being able to handle risk, pursue opportunity, and maintain proper financial governance. So there's a lot of ands connected there to it, all right? So your capacity to operate day to day, to handle risk, to seize opportunity, and you achieve this through two lenses, through strategy and compliance. All right. And they're both really important. And I see that organizations often get focused on one, but we need to take that step back and say, how do both of these help us achieve financial health? So when we think of strategy, I think about maintaining that focus on your mission, the long-term focus, you know, where do you want to be as an organization? What is the impact, your outcomes that you want to see? What's your vision? And then how do you plan for change or risk and make sure you're able to adapt to it? So for example, like nobody knew that in March 2020, we were going to have a pandemic that changed the way that everyone in the world, but also nonprofits, particularly the way that you did business. Organizations that had reserves were nimble, and they were able to adapt more easily to the change in how they were providing services to their community, to their constituents, all right? And so those reserves, having the right types of money available, allowed them to be flexible in their approach to to their community. From a compliance lens, this is about, you know, maintaining transparency and accountability. So it's to keep the trust of funders and the public. And it's also to conform to certain regulatory requirements. So that might mean so you can keep your nonprofit status as a 501c3. It also might mean so you can procure grants from the government if you decide to go for federal grants. You know, there are certain stipulations as you go into state and federal funding that you need to have from a compliance level. And that's what we're talking about. So this is what I mean when I talk about financial health. But before you can assess financial health, we need to know about what the components are. All right. So for the rest of the presentation, we're going to talk about these two components in depth. And right here, what I'm doing is just introducing the framework. All right. So there's a couple points where I'm going to go deep. And if it feels like you are not tracking here, I'm going to come right back to the surface and we'll back up a little bit. All right. But here's what the two components are that we're going to be talking about. It's your business model and your capital structure. And so on the left is your business model. This is how you make and spend money in pursuit of your mission. So what it tells us, in other words, is does your business model generate enough revenue to cover your expenses and all your full costs of the organization, so more than just your day-to-day operations, to meet your mission? So we think about success of your business model by surpluses from a financial perspective. So if you have surpluses, that is success. But we also think of it as mission impact because, you know, we're not operating in a bubble here. If you don't have mission impact, then having a surplus is not necessarily going to be that valuable for you. And where do you find it? So your business model, it is the income statement, which is synonymous with the statement of activities. Those are the same thing. You can also find it on your budget, which is forward-looking. Then on the right, we have our capital structure. This is the type and the size of your balance sheet items. So when I talk about your balance sheet, I'm talking about your assets, your liabilities, and your net worth. Much more challenging for folks to kind of wrap their head around the balance sheet if it's not something you're familiar with. We're going to go deeper into the balance sheet after this. This, like I said, is just the introduction. But for now, it's do you have the right resources on your balance sheet? So do you have the right amounts of cash, property, equipment, reserves, and does it support your mission? So a healthy capital structure means you can innovate, you can adapt your programs to adapt your programs for impact for your community. On a personal level, like if you want a personal analogy, because I feel like that's sometimes helpful to kind of grasp this, is you have savings in the bank. So if your car breaks down unexpectedly and you weren't planning for it in your day-to-day budget, you're okay. So it's allowing you to react and adapt to changes or risks that might come down the path. Any initial questions here? All right, we're going to go a little bit deeper now and start unpacking this. So first, we have the income statement, and this is a simplified income statement. I like to keep it simple in the beginning here. All right, you're often going to have foundations or funders or individuals ask for information from your income statement. You know, if you go onto the giving partner, it's going to ask from a financial perspective some of the data that's found here on your income statement or your statement of activities. And so let's look at here, you know, kind of as a big picture, what's listed. You have your earned and contributed revenue sources. Contributed means your private sources through donors, grants from philanthropy or the government, and in kind would be listed here. Then you have your expenses. Now there's two ways to look at expenses, all right? What I have listed here are your natural expenses. So this is the type or nature of your expenses, your salaries, your utilities, your rent, you know, occupancy, professional fees. I prefer using natural expenses that are classified like this. The other way that you might have seen your expenses listed or requested is by function. And that is where it's categorized by the purpose. Is it a program expense, management, or fundraising? All right. They're both classifications of expenses, so neither is right or wrong, but they will be in different financial statements in different categories, and you might be asked for them in different ways. So the reason that I prefer natural is that there are no accounting standards on how to document your functional expenses. So what that means, all right, if you have two organizations that do the same work, they might classify their expenses different. No one's in the wrong, all right? So this is in the beginning when I said it's a curated expense or it's curated about why finance is hard to talk about. This is what I mean, all right? It doesn't indicate the value of your services when you say X amount of dollars to program, X to fundraising, X to admin or management, all right? And it also provides external audiences a way to judge or evaluate your organization by your overhead, which we know in the nonprofit space is not a valuable measure. And so just to give you an example, and I see there's a question, if your organization cured childhood cancer, all right? As long as you're not misappropriating funds, no one cares if you spent 85% of your funding on overhead. All right. So if you need technology and software and systems and support and a whole lot of administrative staff to support your 2 researchers, and your program supply is not very high because all of it is really actually your software and your technology, nobody's going to say, well, that was too much overhead. Like, you achieved your mission and you achieved your impact. And every organization has different ways to achieve their impact. And so the program management admin expense doesn't really provide anything valuable for us to evaluate an organization. All right, I see there's a question.
Is that me? Is that me, Odie?
Yes, it is.
Okie dokie. Hi, guys. This is Nirda with Funducation. So if you did want to use the natural expenses approach in QuickBooks, would programs fall under personnel?
So it's a different type of classification. And so you would just be listing all of your personnel expenses. So on QuickBooks, there are multiple ways to track your expenses. There's allocation methods where you're taking a percentage of your people and putting them into programs. So it really depends on how your QuickBooks is set up. The program general admin is really only from an auditing perspective that you are putting in your expenses that way. It is not something that you use for planning purposes, or it shouldn't be at least, because it's not going to tell you what you need to deliver on any of your programmatic budgets. So I wouldn't be putting it into QuickBooks at all to say this is program fundraising development or admin. You would be putting it in as, I have $80,000 of personnel expenses. Because at the end of the day, when you print your reports, you need to know what your costs are. Do I need to hire more people? I might have a separate budget that shows me my different programs and then my total budget. And across my programs, you know, development is one of my programs. And so I can see that, and admin is one of my programs. And then all of my other programs are also listed. So I might have that as an internal document. But this is, you know, tracking expenses this way is actually allowing you to plan for the future. It's allowing you to really get an understanding of how you're spending money in pursuit of your mission. I can certainly talk with you offline about some of the mechanics of entering it into QuickBooks separate to this, but this is from a planning and from a data management perspective, what you're going to be using and what you're going to see on financial statements also.
Thank you.
All right. So that's my soapbox about expenses. If you got a little bit lost there, we're going to come back up, so it's okay. At the bottom here, we have our surplus and deficit. All right, so your surplus and deficit, again, did you cover all your operating costs? Did you end up with a surplus? So I have here listed on the right just a couple of questions that I would ask, or, you know, things that I think your statement's going to tell you. So when you're looking at your own information internally, you know, what do you want to pull out from this? So when you look at your revenue dynamics, you're looking at what are your sources of revenue? How stable are they? Do you have reoccurring and reliable revenue? Because reoccurring and reliable revenue is a really fundamental part to stability for a nonprofit. And then what kind of restrictions do you have? Again, as you think about restrictions, you can think about what are some of those strings attached. Do I need to then increase other pieces of my revenue because everything is restricted and it's not going to cover all my operating costs? Breakdown. It's also going to tell me, or questions I can ask are, how many of these expenses are fixed versus variable? You know, can I predict them like rent that's happening every month, or are they project specific costs that are coming up? And then again, for profitability and savings, did I cover my costs? Do I have a surplus or deficit? So what this looks like, all right? This is actually, if you were printing out an income statement or a statement of activities, this is going to be more of the format that it comes out. This is an organization I made up, the Healthy Horizons Collective. But you know, this might be what your data looks like. And so if you were going to be entering this into the giving partner, what kind of additional narrative might you want to provide for that external audience when you're looking at these numbers? Or what might you want to highlight? And so when I look at this, I see, you know, what's my main sources of revenue? This organization has a lot of government contracts and foundation grants, all right? And if you say, oh, this looks like my organization, whenever I put examples up, every organization thinks that it looks like theirs. So they believe me, it's not yours. So what is this telling me? Well, if you have a lot of government contracts, you probably have reimbursement-based grants is what that means. And that takes careful planning for cash flow. And so that would just be something that's on my mind. I might want to tell funders that, but it also might mean that it's really restrictive. Like I said before, government grants might not be covering all your costs then. You know, you can't include your stipends for community participation. You can't include food. It's a 10% indirect rate, sometimes more, but you know, not a huge indirect rate to cover those administrative expenses. And then foundation grants is your main source of revenue here. So that's telling me you need to have grant writing staff on board, and you need to have a team or individuals that are tracking that. When I look at expenses, I see salaries. So I've been working as a consultant for about 10 years now, and I can tell you, if I didn't see salaries as your primary expense, I would have a big question mark of why. So normally in human service organizations, I'll see 60 to 80% of your total expenses as salaries, and that's completely normal. You have people that run your operations, so I would expect that. And then at the bottom here, this is my surplus. I would consider $190 to be pretty much break even. All right, if you're within 2% of your total expenses for your surplus, I consider that to be a break even. All right. So any initial questions here before we move forward? Robert. Nope, you're on mute still.
There you
There
go.
we go. Okay, so I'm the music director of a chamber orchestra. So we're paying people to administrate and to do marketing, and then we're paying people to play the music. All the people that we're paying to play the music are independent contractors. So the word salaries and benefits is a little problematic in the sense there's not really salaries. And so the way we've been classifying this budgetarily is in the sort of that rubric of salaries and benefits, which isn't actually exactly right, is where I put the musicians, the people who actually make the music, and everybody else, so including myself, because so I'm my what I get paid, which okay, so I'm one of those people who are in-kind benefit, of course. I get paid in two ways, one to actually perform and one as executive director, you know, to run the thing. So does that make sense?
Yeah, so I would say there's often multiple ways to have your data listed. So from an internal perspective, if that's helpful for you to segment those expenses to say, these are the people that are playing music, and that's their salaries, and then, or contractors. And then we have our administrative expenses for salaries. If from an internal perspective, that's helpful to segment it, that's fine. From an external perspective, an external audience would need to see what all of your salaries were. And so I hear what you're saying, that salaries here implies that there's a W-2, which it doesn't have to. So you could still have your contractors in this case, because they're providing the services like the music as your salaries. I would want to see as an external audience, all of that combined here, because that's what it takes to deliver on your mission.
Right.
And
so
yep.
So our marketing manager, he goes in professional.
Nope. So your marketing manager would be part of your salaries and benefits. So I would think of professional fees here as like your accountant that you outsource to do your audit, or your lawyer who helps you write contracts. So professional services that are outsourced, not the professional people working within your organization. So I would just change the category as salaries and benefits, and you could just write staff there.
I see.
So it's inclusive of that. Sorry, I didn't make that distinction between what professional was.
Right. So professional means anybody who's external to the organization.
Who's providing like a professional service. So when I say professional service, that means an outsourced professional service. So that would be your accountants, your legal hires, anybody that you need to bring in to consult with you from that perspective.
Okay, but let's say we hire a stage manager to run the concert.
That's part of your salaries, no matter how
Salaries
you
and
pay them. Yep, whether they're a 1099, whether they're in kind, or whether they're salaried, that would still fall under your salary and benefit. A stage manager. Your grant writer would fall there, your administration person, the person who helps with tickets, your executive director, yourself, all of that, and the musicians would all fall under salaries and benefits. That's your staff, your collective staff to deliver on your mission.
Yeah. I'm not sure what that implies to the way our QuickBooks is set up.
I'm happy to speak with you offline after this to see how that's connected to the way your QuickBooks is. Because QuickBooks, I'm not an accountant or a bookkeeper, but I have a lot of familiarity with QuickBooks. And I will say that a lot of expense tracking has to do with how your software was initially set up. And so if your chart of accounts or your classes, which is a technical term in QuickBooks, haven't been set up to track your information in a certain way, then you're not going to get reports that show you the information you need. And so that's a real foundational piece to this.
All right, that's right on the money. And another in-kind person here is my wife, who is the treasurer and handles the disbursements into QuickBooks Online. And I know there's a conflict in there somewhere between the way our accountant set this up and the information we need, because when I extract reports, I get numbers that don't make sense intuitively.
Yep. And that generally is just about the actual setup of QuickBooks and making sure that your chart of accounts matches the same items on your budget, which is how you think of your finances.
Right.
Like I said, I'm happy to chat with you after this. And it's
Okay.
certainly something that I think is raised by a lot of people, because that's a fundamental piece to track your data correct, is to have it entered correct. So thank you for raising that. All right, so we're going to switch from the income statement over to the balance sheet. And like I said before, this is, oh, wait, one more, just kidding. One more thing about the income statement, restricted funding. And so I mentioned restricted funding before. For those of you who aren't familiar with restricted funding, they are donor imposed. So either from philanthropy or from the government or from individuals, and it permits the organization to use funds only as specified. And you can have restrictions in two ways, time-related or purpose-related. So if it's a time restriction, you might have a donor or a large philanthropic group that says, I'm going to give you $1,000 a year for 3 years. And you can spend the $1,000 however you want, but only $1,000 is going to show up for each financial year for your revenue. So even though you receive the $3,000 all at once, you can't use it all at once. Purpose restriction is a foundation says, I'm going to give you $40,000 for your building repairs. So you can't use it on your operating costs. You can't pay your staff with this. You can use this to repair your facilities. Government, again, like I've mentioned a few times, highly restrictive. Whatever you're listing in that budget is what you must use it for. But even more than that, there are lots of restrictions around what you can't use it for. You can't use this for your rent. You can't use it for some other indirect expenses. So restricted revenue is a really important part of nonprofit finance, and it doesn't exist in the for-profit space. All right, now we're going to shift over to the balance sheet. Sorry, I got ahead of myself there. So like I said, the balance sheet is a little bit different and harder sometimes to wrap your arms around. This is different than your business model in that it's an accumulation of activity over time. So what that means is your income statement is going to look at from January 1st to December 31st and the accumulation of all the things that have happened in that 12 months. Your balance sheet is a snapshot in time at that particular date. So if I pull my balance sheet from today, it's telling me the resources that I have available today. Tomorrow, this might look very different. All right. One way that I like to look at the balance sheet to conceptualize it is to say, if all your revenue stopped flowing, what resources would you have on hand? So what types of resources, and would they support your mission today? And when we actually read it, it's the reflection of what you own, what you owe, and then your net worth. So on the left, you have your assets. This is what you own. It's your cash in the bank. It's the money that's owed to you. So you've sent an invoice and you're waiting for payment, but you've already provided a service. And investments, if you have any, and your property and equipment. On the right, you have your liabilities, and this is what you owe. So bills, so maybe outstanding invoices, your line of credit. If you have that kind of line of credit, it's a type of debt. Deferred revenue, somebody has paid for the service, you still need to provide that service. And then just bigger debt. So that might be property and equipment debt that you have. And then on the bottom, we have your net assets. This is your net worth. Also, because it's called a balance sheet, it balances. So your assets minus your liabilities equals your net assets. And your net assets are divided with restrictions and without restrictions. All right. So when I talk about balance sheets, I always like to give analogies because I think it's easier to understand it. Excuse me. So if you purchased a $20,000 Honda Civic, it would show up in your assets as a $20,000 piece of equipment that you own. All right. But I took out a $15,000 loan for it. All right. So that $15,000 that I owe for the car that I have to pay my interest and my principal on is going to show up in my liabilities. I owe that. And that means that I paid $5,000 upfront. So $5,000 of that car is my net worth. It's truly mine. It's what I actually own of that vehicle today. So like I said, tomorrow, maybe I made an interest payment. My assets are still going to stay the same. It's still worth $20,000, but I owe less on it. and I own more. And so that's how it's continuously balancing on that balance sheet. All right. So the questions that I ask when I look at a balance sheet, all right, do you have access to the resources you need? And we'll talk about this a little bit more. One of the things that you'll often see with nonprofits is pre-COVID, they had a lot of office space. So they had a lot of property or a lot of equipment. And then post-COVID, nobody goes into the office. And so if I see a lot of property and I see that they own buildings, I'd kind of want to know, are you using those buildings? Are they relevant to your mission still today? One thing that I do want to highlight is assets don't always mean good. Liabilities don't mean bad. So it's not a binary of good and bad when we look at the balance sheet. It's just what it is. It's just the way you have resources and that you're leveraged within your organization. So on the liabilities, do you owe more than you own? Are your obligations manageable? So if you have debt, are you able to pay the interest and the principal, or is that a challenge for you? And then how do you manage your cash flow if you have a line of credit? And then from a net assets perspective, I want to know how much is liquid. Liquid is unrestricted, that doesn't have strings attached to it. And we'll talk a little bit more about that. All right, so let's look at our example here. We're back to the Healthy Horizons Collective. So if I was looking at their balance sheet, what would I be pulling out here? I want to look at the driving asset. Where is the biggest number? That's a great start when you look at your balance sheet, okay? There's a lot of big numbers here. I'm seeing cash, I'm seeing grants and pledges receivable, what's owed to them, and I'm seeing property and equipment, net. Net means that it has taken into account what has depreciated over time, knowing that property and equipment loses value over a series of time. All right. So the question that I would have for property and equipment is this property and equipment relevant? Like I just said, do you own office space, but your staff are remote? Usually also, if I see a lot of property, I would think that part of your business model is having people in that space. So maybe if you're providing music to the community, maybe it's your performing space. If you're providing education, it's butts and seats. You know, you have young people coming and using that space to deliver on your mission. And so I'd want to know, is that relevant still? Are you using it for your mission? Because sometimes the answer is no. I'd also want to know how dilapidated or how old is that equipment? And so do you have a lot of operating costs that come with that property and equipment? Because maybe you have to constantly fix up that equipment or that property because your office space is just deteriorating. And so that's an important piece to manage, but also to tell an external audience. You know, we have $400,000 in property and it costs us another $80,000 a year on our budget to manage that property to fix it. From liabilities, again, what's your biggest liability here? This one, it's a line of credit, which means that, you know, that this is supporting their cash flow. If you recall on the income statement, this organization had a lot of restricted grants from the government. That means they're reimbursement based. You have to put that money out and pay for your services. You collect your receipts, you submit it to the government, then they pay you back. That creates a cash flow challenge for a lot of organizations. One way to manage that is by having a line of credit. So again, not good or bad, it's just telling me a story about the organization. With donor restrictions, so this is telling me that of my net worth, of my reserves that I have, a lot of that still has strings attached to it, which means it's not truly mine to use however I want. If I wanted to make an investment into my organization, I can't use that restricted dollars. Or with donor restrictions on the bottom, I have to use the without donor restrictions. So this is telling me that I have a decent nest egg to kind of weather challenges or to explore innovation. All right, so how do we bring these together? Okay, so we talked about the income statement on the left. we talked about your balance sheet on the right. These are connected. And this is a really critical piece to understanding the financial statements. On an annual basis, any surplus or deficit that you have is going to go directly into your net assets. Meaning, think of it from a personal level. Every year when you have your personal budget of this is how much I need to spend of my salary, anything that's left over goes into your long-term savings. If you overspent this year, which is typical, you know, organizations are always at some point in their life cycle going to have a deficit. That's okay. Change often spurs deficits. But if you have a deficit, that money needs to come from your nest egg, from your reserves, from those net assets. And so over time, it's important to build those. And you build it through surpluses. And that way you can weather that change when you have a deficit. How are folks feeling with that connection and as we go through the two of those concepts? The balance sheet is challenging to really kind of wrap around. It takes a lot of repetition. And so one of the things that I really recommend organizations do is look at your balance sheet after this and start thinking about what are the resources that you have there and what do they mean? Because that's the way that you're going to start developing your story. Any questions before we move forward here? I know that was a lot of technical information that comes at once. All right. Great. Okay. So organizations often ask, what are the measurements? Like, how do we measure how we're doing as an organization? And so there are a few different measures for what I would call financial adaptability. And I like to first give kind of a warning here about the numbers that you come up with. They're going to be, well, organizations ask me what the right numbers are. And I would say that there is no right number. Whatever your measure of financial adaptability is going to be very dependent on your business model. All right, and I'll give you a further explanation in just a minute here. So the first measure that you can do to look at your own finances, and I'm going to send this part to you afterwards so you can look at this and have this on your own records, okay, is looking at liquidity. And we look at that in a few different ways. One of them is by looking at cash. So you look at your cash on hand. So what's in your bank account today? And this is the ability for your organization to cover short-term obligations and day-to-day expenses. And so how many months of cash do you have? That's one of our indicators. So you take your total cash, which is from your balance sheet, and then we want to figure out your monthly operating expenses, which comes from your income statement. So we take your total annual expenses and we divide it by 12. That's how you get your monthly expenses, all right? And that's going to give us an indication of what your months of cash are. Now, there's kind of a standard to say most organizations want 3 months of cash. And I think that that's a good standard, but it doesn't always apply to every single organization. And so think of this as the same from a personal level, how financial advisors will say you should have an emergency cash reserve. And I think that that's usually like 4 months of your own personal expenses. So that way, if you lost your job or if there was an emergency, you could still continue your day-to-day life for 3 to 4 months before you ran out of money. All right. And so that's what this is measuring. Now, there's not a right number. Some organizations might have 1 month of cash on hand, and they might tell you, I feel really comfortable with that. We are not looking at our bank account. Our expenses are very predictable. So we know exactly when we're paying for things. We don't need to make a big expense out of the blue, so we can plan. Other organizations have lots of large expenses that happen periodically. And so having 1 or 2 months of cash on hand is not going to make them feel comfortable. So another way to measure this is just how it feels. If you are a finance manager or an executive director that is checking your bank account for the organization every week before you run payroll, that is an indication that you are low on cash or that it is critical. All right. If you're really worried always that you're going to bounce a check. All right. So it's not always a number that's going to give you that indication. Some of it's the feel of it. The other way to look at liquidity is by looking at your available net assets. And I always hesitate to give organizations this next measurement because it's a little bit confusing to look at. So again, if this feels like we have gone too deep, that's okay. You don't need to know this in order to still have successful finances. This is just one way for those folks that like to go that extra mile. Not all cash that you have is available. And that's what we talked about before when we talked about your net assets. All right. Some of them are going to have restrictions on it. So you might have cash in the bank, but it's technically designated or earmarked for something. And so we look at your available net assets, and this is really measuring your available resources. And this is your safety net. This to me is actually a true indicator of what your financial health is, because it shows that ability to navigate risk and pursue opportunity. Now, some of you, when you do this, you will come up with the exact same number as your months of cash. Some of you will come up with very different numbers, and that is based on restrictions, and it is based on property and equipment, and it is based on your debt. So what we're looking at here is your total net assets without restrictions, so from your balance sheet, and we're going to subtract the value of your property and equipment. And the reason we do that is if you have cash, well, this isn't cash, if you have money in your reserves, some of that is going to be the value of your property. Like I said, you bought that car, $5,000 of that vehicle is yours. I can't pay my staff with that $5,000 worth of that car that I own. So it's still part of my value, but I can't pay. It's not liquid. And so I want to take out the vehicle. I want to take out the value of it. Then I'm going to look at my monthly operating expenses, and that's going to give me my month of available net assets. Two very different indicators. Like I said, if that feels too much, that's okay. You can disregard them. All right. So just recapping a little bit about what we just talked about today. This is about understanding your financial statements and understanding the information. So when I talk about the positives, these are things you should celebrate, you should feel comfortable talking about, and that you should be sharing with internal and external audiences. So positives would be consistent, unrestricted operating surpluses, revenue that's reliable and repeatable year over year, surpluses that you have that cover your longer term needs. So those surpluses, like I said, they feed your balance sheet and they help cover for things that are not your day-to-day expenses like depreciation, reinvesting your fixed assets. If you have that ability to manage debt, both the principal and the interest, you should be talking about that, about how you do it for your funders. Cash flow is easily managed. And I wrote a little asterisk here because easily is subjective. It's how cash flow feels for you. It doesn't have to be based on that indicator, and that your available net assets allow for innovation, change, and reserves. Things that you might want to examine further. So I wouldn't say that they are red flags, but they are things that you will also need to talk about for an external audience if they show up on your financial statements. Declining operating results. All right. So if you are consistently seeing deficits, you need to be able to explain why. It doesn't mean that there is something wrong with your organization or your management, but you need to explain why that's occurring. So look at your revenue and expenses and come up with a reason behind that. If you're seeing significant swings in revenue composition, changing of funders without a real clear explanation or pathway forward, that's hard to manage that when you don't have consistent revenue. And so talk about that. Talk about what that plan might be going forward. You have high liabilities relative to your total assets. That's a lot of debt or payables, and lower declining liquidity. So if you do those financial indicators and you see that you are not a very liquid organization, that's important for your funders to know that, because if they are giving you more restricted funding, it is going to put stress on your organization. And so you need to be pushing for general operating support instead. All right. So that's a lot of information. Like I said to you, we go into the weeds from kind of that high level of talking about the nonprofit business model, but I appreciate that you sat through that. Are there any questions? We still have about 10 minutes left, which I really wanted to leave in case people wanted to discuss kind of big questions or very specific questions also. Like I said, the MOC and ANA, those are your liquidity indicators, your months of cash and your available net assets. After this, there's just a one-pager that shows you how to get those indicators if you want to measure them within your organization, and we'll send those out to you.
Lisa, you've got her hand up.
Oh, Eula.
Just setting up QuickBooks and trying to understand how balance sheets and all of those things work. Do you recommend any website or resource on how to do it with the chart of accounts? I did some basic research and I understand the value of setting it up correctly so I can run the reports I need for funders, for example, and what the gentleman mentioned. I'm just not sure which ones. And as I look at different articles, when you mentioned the natural, it's like, okay, and then you mentioned do certain things internally because I do need that information, but don't put it in the books. Do you have some suggestion on how to address that to make the best first steps going forward?
Yeah, so there are a lot of online webinars about using QuickBooks within your organization for nonprofits. And I am drawing a blank on what one of the presenters' names are, but I will look it up and I can send it to you after this if you'd like to send me an email. And they provide a really fantastic foundation to it. It is a 2.5 or 3 hour webinar. It is long, but it also provides a really great perspective of starting from the basics within your organization. A lot of the information can be found online if you even look through the QuickBooks website or their webpage. However, for me personally, I think it depends on what kind of learner you are. I find that workshops are easier because I can apply it in real time. Like I said, I'm drawing a blank on what their name is, but I see they're specific to nonprofits. They look at QuickBooks both on desktop and online. And that's a great resource, I think, for a starting point.
Thank you.
Robert, go ahead, please.
Yeah, so maybe you can shed a little bit of light on this problem. So most of our financial reports, I'm talking about 990 mainly, and the state agricultural, I forgot what they're called, where you have to file financial reports in order to get licenses to raise money. So they ask for fiscal year, and so that fiscal year is calendar year, January 1, December 31. But we're a performing arts organization, and our season, which is the best time frame that reflects when the money's coming in and when the money's going out, is really July 1, June 30, which also to some extent is arbitrary because ahead of July 1, some money comes in, which is really for the next, we'll call it seasonal year, which was what we use as a budget year. So
Yep.
the conflict between fiscal year, calendar year, and what our operational year is drives me nuts.
Yeah. So you're not alone, first of all, in that. There's two things to address here. So your fiscal year is yours internally as an organization. So you determine what your fiscal year is. And so if a July 1st start date makes sense for your operations, then that should be your fiscal year, and your 990 would reflect that. Your 990 and your audits reflect your own fiscal year, not a calendar year. With that said,
Actually, not
ahead.
according to the accountants. The accountants
Oh.
say that what we file with the government, we're best off to do it January 1, December 31. And that's what we've been doing.
Okay, that's interesting that that's what your accountant is recommending. So I often don't see that. Usually I see an organization assign their fiscal year based on what works for them, and their accountants would support that in their financial reporting. Where the challenge often comes up is for when you're applying for grants, and the grant calendar doesn't align with it. And so you need to create a budget for the calendar year, even though that's not really how you deliver your services.
Yeah.
And so
Apparently
ahead.
we're doing it the opposite of that.
Okay. I think it would be worthwhile to have a conversation with your accountants about that. And I'd be happy to send you some additional information around that if you want to email me, Robert,
will.
because that's something to sort out internally within how you're creating that fiscal year for the organization, which would make sense. Your budget should align with whatever your financial statements say. They shouldn't be different.
Okay, I'll write you a note.
Thank you. And good questions. Thank you for bringing those. Anything else?
Hi, Lisa, this is Scott. You touched on it earlier, but after getting your complete presentation, I think it's really helpful to understand that when we understand the story that our finances share, it helps us share that story with boards, with funders, with other folks that we want to be stakeholders or have relationships with. Could you talk just a wee bit, just for a minute or two, about how to use a budget or a financial narrative to go along with your financial statements to kind of articulate that? It's also kind of an odd way of demonstrating your ability to understand the story that your finances tell and build some credibility as well.
Absolutely. And so I think that goes a lot to talking about, that finances can be curated or not. So anyone external, when they look at those financial numbers, are going to come up with their own story, because there are lots of stories that you can create by looking at numbers, and they're not always going to be correct. And so it is incredibly important that when you are giving financials to any external audience, that you are writing that summary of how you want them to understand your story. And you're controlling that narrative. And so I would really when I say to review your financial statements and some of those questions to start asking, I would get into that practice of both speaking to it, but writing it down. Your development team needs to have that information. Your finance manager needs to have it, and your executive director needs to have it at a minimum. And they all need to be on the same page about your storytelling. Why do you need certain resources to support your mission? What types of resources do you need? Everybody talks about general operating support being like, that's the kind of money everyone needs, and it is. But how do you explain why? Where are your finances restrictive? What's not covered right now by your existing funding? And so really getting comfortable in any kind of grant narrative, anytime that you're submitting financials to anyone, to have that explanation of how you're using your money and what's important is going to be critical. So that way their interpretation is aligned with your interpretation. And that's something that I really see as a huge gap with a lot of nonprofits, is that whoever that external audience is, they're misunderstanding your story, and you have your own story that you need to own. Even if things have happened that were challenging in the past, own it. Don't, anyone that looks at your numbers is going to see it. So own why that happened. It's not a detriment to your management. It's that we lost funders. We received lots of funding during COVID, and then 2023 came around and all those funders pulled back. That's why you see a huge decline in our revenue in the last 2 years. If you don't say that, somebody external could look at your finances and be like, you lost 25% of your revenue. Like, bad management? What happened? Did you change your mission? And they're going to make an assumption without you telling them that story. So storytelling is a really critical piece, and also internally for your board, for your staff, so everyone's on the same page. Well, thank you everybody for coming today. I appreciate you being here. And I hope to see some of you again in the future. And like I said, please feel free to reach out to me if you have additional questions on any of the content that we discussed today, or if there are other questions that weren't raised today as well.